Hello everyone, welcome back to Financial Path. Are you thinking about investing, but not quite sure where to begin? Maybe you've heard about real estate, individual stocks, gold, bonds, or even cryptocurrency, and now you feel like you're standing in front of a buffet of financial choices, not knowing which plate to pick. That's totally normal. In today's world, there are so many ways to grow your money, but not every option is beginner-friendly. Some require large amounts of capital, deep research, or the ability to handle high risk and wild market swings. So, where should you start? If you're looking for something simple, low cost, well diversified, and proven over time, two investment vehicles really stand out: index funds and ETFs, exchange-traded funds. These two options are often recommended by financial experts, and for good reason. They let you invest in the entire stock market without picking individual stocks. However, despite their popularity, many beginners are unfamiliar with these two investment options, and upon further reading or watching, they often find them more confusing. What's the difference between the two? Why are there so many terms relating to them? Do some terms refer to the same vehicle? And how do you know which one fits you best? In this video, I will break it all down clearly. More importantly, you'll learn and clarify what an index fund is, what an ETF is, how they're similar, how they're different, and how to choose between them when investing in them. I will also show you a real example of how investing $100,000 in either an index fund or ETFs can grow over a specific period, allowing you to see which one can bring you the most financial benefit. Alright, let's get started. However, to avoid confusion, before we discuss index fund and ETF investments, it is necessary to understand what each term represents to prevent losing the idea. If you've ever felt confused while reading an article or watching a video regarding index funds or ETFs, you're not alone, as these articles often use the terminology interchangeably, resulting in only seasoned investors understanding these terms clearly. The financial world often uses these labels loosely, leaving beginners scratching their heads. However, don't worry. I will walk you through it clearly and step by step. Let's define each term properly. 1. Mutual fund. A mutual fund is a type of investment fund that collects money from many investors and uses it to buy a diversified portfolio of assets like stocks or bonds. A mutual fund can be either actively managed, where a professional fund manager selects specific investments trying to beat the market. This is often just called a mutual fund in everyday language. Passively managed, where the fund simply tracks a market index like the S&P 500. In that case, it's called an index mutual fund. When you hear the term mutual fund, it can refer to either an active or passive fund, but it typically denotes an actively managed fund unless otherwise specified. 2. Index fund. Here's where many people get tripped up. An index fund is not a specific fund, it's a strategy. It's a type of fund that passively tracks a market index. And importantly, this fund could be a mutual fund called an index mutual fund or an ETF called an index ETF. So when someone says index fund, they might mean either of these. In practice, however, many people, including the media, use index fund to refer to an index mutual fund, unless they specify otherwise. 3. Index mutual fund. This is a mutual fund that passively follows an index. It's priced once per day after the market closes. You typically purchase it directly from the fund provider, such as Vanguard or Fidelity. It's great for automation and long-term retirement accounts. 4. ETF. Exchange-traded fund. An ETF is a fund that you can buy and sell on the stock market, just like a stock. Its price changes throughout the day as investors trade it. An ETF can be either actively managed or passively managed. However, when people say ETF, they usually mean a passively managed one, especially in introductory discussions like this. 5. Index ETF. This is the passive version of an ETF. It also tracks a market index just like an index mutual fund, but it trades all day long like a stock. It's often used in regular brokerage accounts where flexibility and tax efficiency matter. To clarify, in our video, index funds versus ETFs, it really means index mutual funds versus index ETFs. Both are passive index tracking investments, and they are just packaged differently. If you're still unsure, here's the reassurance. When we say index funds, we're talking about index mutual funds, the passively managed mutual funds. When we say ETFs, we're referring to index ETFs, also the passive kind, not the actively managed ones. This clarification is crucial because it enables you to focus on the primary question. Do you want to invest through an index mutual fund structure or an index ETF structure? That's what we'll unpack next. After clarifying the terminology, it is necessary to conduct a brief analysis of how they are created and how they function. Both are passively managed funds, so index mutual funds and index ETFs are built around the same idea. They are designed to track the performance of a specific market index, such as the S&P 500, the NASDAQ, or the Dow Jones Industrial Average. To achieve this, fund providers, such as Vanguard, Fidelity, Schwab, or BlackRock, through iShares, create a fund that holds all or a representative sample of the stocks in the index. The goal is to match the index's performance as closely as possible. For example, an S&P 500 index fund would try to hold the same 500 companies in the same proportions as the index itself. If Apple accounts for 7% of the S&P 500, the fund also aims to hold approximately 7% of Apple. ETFs are a type of fund that owns a diverse range of securities, typically of a single asset type. For example, a stock ETF holds stocks, while a bond ETF holds bonds. One share of the ETF gives buyers ownership of all the stocks or bonds in the fund. For example, if an ETF held 100 stocks, then those who owned the fund would own a stake, a very tiny one, in each of those 100 stocks. Even though both are constructed based on similar ideas, the way the relevant fund operates and how you buy into it will be different depending on whether it's an index mutual fund or an index ETF. These funds are typically created and managed by investment companies like Vanguard, Fidelity, Charles Schwab, BlackRock, iShares, and State Street, SPDR. These providers build the fund to match the chosen index, handle trading and rebalancing when the benchmark index changes, charge a small expense ratio to manage the fund, usually very low for index funds. Index mutual funds pool money to buy a portfolio of stocks or bonds. Investors buy shares directly from the mutual fund company at the net asset value, NAV price, calculated at the end of each trading day. You don't see real-time trading. It's more of a set-it-and-forget-it model. Great for retirement accounts like 401ks or IRAs. Index ETFs. You buy and sell them through a brokerage. The price changes throughout the day. You can use advanced strategies like stop-loss orders or buy-sell instantly during trading hours. Great for flexible brokerage accounts. Both types of funds do not let you own individual stocks. Instead, you own shares of the fund, which in turn owns the stocks. So, you get exposure to the whole index without having to buy 500 individual companies. Although index mutual funds were introduced earlier in the US market, there are now more categories of ETFs, which are also more popular, including sector ETFs, commodity ETFs, stock ETFs, bond ETFs, international ETFs, Bitcoin ETFs, leveraged ETFs, and inverse ETFs. As the expansive description of these categories is not our focus this time, I will not expand their explanation. Later, if opportunities arise and it is necessary, I will create a specific video to discuss these categories in depth. After learning about their creation and working method, let's examine the pros and cons of each. Index mutual funds are one of the most popular and beginner-friendly ways to invest in the stock market. Their biggest strength is their simplicity. When you invest in an index mutual fund, you're buying into a large collection of stocks or bonds that mirror a specific market index, like the S&P 500. This gives you instant diversification without the need to choose individual stocks. One of the major advantages is that they're perfect for long-term hands-off investing. You don't need to check prices every day or time the market. In fact, you can't trade them throughout the day. They're priced only once at the end of each trading day. That might sound like a limitation, but for many people, especially beginners, it helps remove the temptation to react emotionally to market swings. Another benefit is that they're easy to automate. You can set up recurring contributions through your brokerage or retirement account and let the fund quietly grow over time. They're also known for having low fees. Because they follow a passive strategy and don't require a manager to make daily stock-picking decisions, the cost of managing them is low, and that means more of your money stays invested. The Investment Company Institute found that index mutual funds expense ratios averaged 0.05% per year in 2024, a rate that has been declining for years. However, there are a few downsides. First, since you can't trade them during the day, they offer less flexibility than ETFs. You may also have higher minimum investment requirements. Some funds require $1,000 or even $3,000 to get started, which can be a barrier for beginners. Finally, they may not be as tax efficient as ETFs, especially in taxable accounts, though this is usually less of a concern in retirement accounts. Overall, index mutual funds are a solid choice for patient, long-term investors who want something simple, automated, and low cost. Index ETFs, or exchange-traded funds, are another great way for beginners to invest in the stock market. Like index mutual funds, they also aim to match the performance of a specific market index, such as the S&P 500 or the NASDAQ 100. But they come with some unique features that make them more flexible and accessible for many investors. One of the biggest advantages of index ETFs is that they trade like regular stocks. This means you can buy and sell them throughout the day at real-time prices. For example, if you decide to invest in the Vanguard S&P 500 ETF, VOO, you can buy a share at 10 a.m. and sell it at 3 p.m., just like a stock. ETFs also offer low cost and low entry barriers. Many require no minimum investment beyond the price of one share, which could be as low as $50 or $100. Some platforms even let you buy fractional shares, starting with as little as $10 or $20. Another big benefit is dividends. If the companies inside your ETF pay dividends, you'll receive your share, usually monthly or quarterly. This can be a nice source of passive income or reinvested to grow your investment. Just know that if you're investing in a taxable account, those dividends are usually taxed in the year you receive them, even if you don't sell anything. But if you're using a retirement account like a Roth IRA or 401k, you won't owe taxes on those dividends right away, or at all in some cases. ETFs are also known for being tax efficient when it comes to capital gains, making them a wise choice for taxable accounts. However, ETFs do have downsides. Since they trade like stocks, beginners may be tempted to constantly check prices or try to time the market, which often leads to emotional decisions. And while most platforms offer commission-free trading, there can still be small costs, especially if you trade frequently. Still, for flexibility, low startup cost, and potential dividend income, index ETFs are a powerful option for building wealth over time. After understanding the pros and cons of the two funds, it is necessary to compare and reorganize the commonalities and differences between them to deepen your impression and understanding. Diversification. Both give you exposure to hundreds of companies, like the S&P 500, in one purchase. Low cost. Since they track an index and don't hire teams of analysts, fees are minimal. Passive management. No one's trying to pick winners. Both types of structured funds mirror the market. Strong long-term returns. Historically, passive index tracking has beaten most active strategies. Both receive dividends. In short, both are solid long-term investments for beginners. 1. Trading flexibility. Index mutual funds. You can only buy or sell once per day based on the closing price, which is the net asset value of the fund, NAV. ETFs. Trade like stocks. Buy or sell anytime during market hours, with prices changing in real time. 2. Minimum investment. Index mutual funds may require $1,000, $3,000 to start. ETFs. You can often buy just one share, sometimes even fractional shares. 3. Tax efficiency. ETFs. Generally more tax efficient due to their structure. They use an in-kind redemption process that allows them to avoid triggering capital gains. Index mutual funds. You might owe taxes even if you didn't sell anything, due to fund-wide capital gains. 4. Automatic investing. Index mutual funds. Many brokers allow you to set up automatic contributions. ETFs. Harder to automate unless you use fractional investing platforms. 5. Costs and fees. Both can have extremely low expense ratios, around 0.03% to 0.06%. ETFs might have small trading fees or bid-ask spreads. Index mutual funds usually have no trading fees, but fewer pricing advantages. The best way to understand the two types of fund structure is to take a specific example. Let's say you invest $100,000 today and you let it grow for 30 years. No extra contributions are required, just a one-time investment with the dividend reinvested back into the fund. Then, which will give you more money, the ETF or the index mutual fund? Today, I will demonstrate this comparison using a real ETF, VOO, and an index fund, VFIAX, from Vanguard. Assumption 1. ETF, VOO. VOO is an S&P 500 index ETF. Since its launch in 2010, VOO has returned 14.55% per year on average. But to be conservative, we're going to use 11.1%. which reflects a more reasonable long-term total return expectation. This already includes dividends reinvested and capital gains. Using 11.1%, a $100,000 investment would grow to around $2.4 million in 30 years using the compound formula. Assumption 2. Index Fund, VFIAX. VFIAX is an index mutual fund that also tracks an S&P 500 performance. It has existed since the year 2000. Its actual average return since inception is about 8.4%. Again, this figure already includes reinvested dividends and price growth. Using 8.4%, that same $100,000 investment would grow to about $1.12 million after 30 years. Even though the result expects that VOO ETF performs better than VFIAX index fund over the next 30 years, this example can't conclude that ETFs will be better than index funds. So, what's the takeaway? This doesn't mean that VOO as an ETF is always better than VFIAX. Both track the same S&P 500 index and both are strong choices, but due to structural differences and historical timelines, the total return may vary. If they started at the same time and tracked the same S&P 500 index, the final value should be nearly identical. Therefore, the important thing is to pick the option that matches your goals, keep your fees low, and stay invested for the long term. You might have seen other videos or articles claiming that ETFs massively outperform index funds, sometimes showing a $1 or even $2 million difference over time. But be careful, these examples often compare apples to oranges. These videos often use dividend-focused ETFs and compared them to index mutual funds with different strategies, assuming very aggressive dividend growth rates. That's misleading. To compare the performance of ETFs and index funds, we need to use the same strategy, which means both are tracking the S&P 500 or both mirror the NASDAQ 100. When comparing similar index strategies such as VFIX and VOO, the final portfolio values are usually slightly different. So now the big question, which one should you choose? Index mutual funds or index ETFs? The truth is, both are excellent long-term investment choices. They offer low fees, broad diversification, and solid returns over time. But the better choice for you depends on your personal investing style, goals, and account type. If you're someone who values simplicity and automation, index mutual funds are probably the better fit. They're ideal for retirement accounts like 401ks or IRAs, where you can set up automatic monthly contributions and not worry about daily price movements. They also work well if you prefer a set-it-and-forget-it strategy. On the other hand, if you want more control and flexibility, index ETFs are likely a better choice. They allow you to trade throughout the day and often have lower minimum investment requirements. They also tend to be more tax efficient, making them a great option for regular taxable brokerage accounts. Here's a simple way to think about it. If you're using a retirement account, go with index mutual funds. If you're using a brokerage account, ETFs might give you more benefits. Many investors actually use both, mutual funds in their retirement plans and ETFs in their regular investment accounts. It doesn't have to be an either-or situation. The key is to choose the one that fits your lifestyle and helps you stay consistent, because staying invested is what really builds wealth over time. Just remember, whether you pick index funds or ETFs, the real win is starting early, keeping costs low, and staying consistent. Now that you know how to get started with ETFs and index funds, the next step is to put your knowledge into action. If this video helped clear up the confusion between the two, give it a like and subscribe to Financial Path for more simple, beginner-friendly investing tips, and we'd love to hear from you in the comments. Are you leaning toward ETFs or index mutual funds? Which part of this guide helped you the most? Thank you for watching. I'll see you in the next video.